Monthly update of the stock market using the business cycle models. I'm Rich Poss for Critical Point. It is March 11, 2024. For those of you who are new subscribers, followers, just have an interest, I'm going to start out with the long term, which is what the monthly is about, but towards the end, I'll also give you an insight on how this service can help you in trading stock index futures or funds, ETF funds, or just to help you with your overall stock trading and investing. But this method is also applied to Bitcoin, gold, and a variety of other markets. And then I'm a big believer in using business cycles to help us track the economy, if not time the economy. Okay, let's first discuss a super cycle that bottomed in March 2009. I was fortunate enough to turn bullish that month, and I was fortunate enough to be bullish until about 2018 to 2021, when I was expecting a minus 20 to minus 50% drop, and the market dropped 35%. So this line is set for the closing price of February of 2024, and from that super cycle bottom, the market for the S&P 500 cash was up 664%. That line may well extend all the way to 2050 for all I know in terms of super cycles, but we may learn there's some disruptions coming towards the end of this decade and something may occur sooner. But anyways, that is super cycle performance from 2009. That's what the market did, and this modeling was helping to assess that and look for opportunities to buy one of those in 2009. And you could have held on an investment all this time. And there are investments that track the S&P 500, such as a SPY fund, that should have been just about the same performance. Now, I am calculating this from about the lowest price, so nobody can buy the true low, or maybe once in a while you can. So your performance might be a little bit less. All right. And then, of course, you may have some costs built into your fund. Now, within the super cycle, that I think's up until 2050, but again, and that's another story for another day. What I'm most interested in is the decade pattern. What does the market do for a decade? What does it do during the decade? And what does it do during the year? That's a primary focus. Second focus is what is it doing during a month or for a month, during a week, and maybe during a day. Third focus is during a day, but mostly is hindsight, additional information. I'm not offering a day trading service. And then on the other end of the spectrum are the super cycles. So they actually rank third. So this line is showing us the once a decade buy signal and sell signal when I was bullish from here. And then I started looking for a top there and there. And then I said, you know what, this is going to take a while. And then about 2 hours of that top related to the COVID turned bearish. I even pulled all of my money out and bet on the downside. So I was net short the market. And then was fortunate enough to buy it 2 days after it bottomed in March 2009, and I said be a long-term bull. For this bull cycle, this right here, this is LT1 for a label of that for the stock market, but it actually relates to the juggler business cycle that you can look up online and was part of Schumpeter's business cycle model from a few years to like 50 years or things like that. All right. So the market rallied about 409% for that bull market, dropped about 35%, started a brand new bull market. So as I move this chart over, this line that's up 132% as of February of 2024, that line's going to extend to near the end of the decade when I expect it to drop, or the market to drop, minus 20 to minus 50%. In the meantime, trend is up, and I think the S&P 500 can be at 5,400 this year. I think it can be at 56 to 6,000 by late 2025 on into late 2026, and we might yet see 6,800 to 8,500 for this decade. But again, when I get that decade sell, I'm going to be concerned of a minus 20 to minus 50% drop, and could even be a bit more because there are some super cycles that may make an impact, okay? Now, that's that line. Now, you can see we had a large up move and then drop into 2022 in inflation, and the modeling did warn late 2020, 2021 to consider some of our favorite indicators for the economy to drop, but we would not go into a recession. And to consider the stock market would drop anywhere from -7, -11%, but maybe would risk as much as 36% down, but more likely no more than the 20% area. Well, it dropped 25%, and the reason is we brought in inflation, we brought in the war on the stock market, the economy, in order to have a war on inflation and rebalance, recorrect things. So it was understandable why it went for the lower targets and understandable where it bottomed, but the model said that was an extreme undervaluation. We did not need to drop it that far, and the model was correct in warning we were not going to have a recession, when most economists, U.S. and globally, forecast a recession. They were way, way off the mark, and these business cycles warned us we won't have a recession in the U.S. All right, at any rate, we've got a new minor long-term bull market. So this is an LT3 for the stock market, but for the economy, it's what's called a Kitchen business cycle, and you can look that up online. And the Kitchen relates to a throttling up, throttling down process for the economy and the stock market throughout a decade, for that decade pattern. So this bull market currently up about 46% as of February, and I think it's got higher to go. I think it's going to go to 5,400. Okay. So now, what does this mean on the economy side? Well, basically, the research throughout the history of this country, and in adding countries like England, Europe, continent, and things like that, before that, going all the way back in the 1700s, and then I can convert it to just history, going back 1,000 years of the economy, but also using commodities as an insight, going back 1,000 years, believe it or not, and still find cyclical patterns back then that still work today, believe it or not. Basically, the economy grows for 7 to 12 years. That's how long it takes us to borrow too much to get to a point that something breaks or we break it, and that can include the Federal Reserve or government breaking it. Okay, then we have a recession. There's sometimes more than one recession per decade, but in my opinion, there's one primary cyclical recession per decade pattern, per juggler business cycle. All right. Now, once that's out of the way, we basically just start over again, print more money, we go back to work, we rebuild the economy for the next decade, and the stock market moves to yet another record high. Okay. And so this has worked very well for me since, I've been doing cyclical research since 1980s, but I designed this model late 90s, mid 90s for commodities, then realized it could work in stocks and commodities. And in the 2000s, I said, I got to get more aggressive about this and use. And it helped me with the early 2000s recession. It helped me with the great financial crisis when I said the model said 70 to 90% down, but I said, probably no more than 40 or 60% down. It was down 55%. But I also said there ought to be a country when it was still down 70, 90%, and it was down 85% in Russia. It worked, okay? And so this is doing very well for me, and I actually have returns like this. I have an account that I started back in 2010 that still holds an investment where I got out near the top, bought in the bottom, and I've jumped out a few times to manage risk, but generally I want to follow this larger up move. That's up 1,300%. So become a member here, a subscriber, criticalpointpod.com. You can go to the actual host video site, criticalpoint.podbean.com. So that's our monthly update that we still have to be bullish this year. We have to be bullish this decade. But we also have to realize there's probably a recession coming near the end of the decade, and we got a bear market. Okay, so that's the normal monthly update. Now I'm going to give a little update for new people or people. I might be putting this out for free. They might want to join us. What do we do during the year? How do we buy along with these bull markets? And when you're just automatically putting money into retirement accounts, you're buying higher and higher and higher, and everybody would have been doing the same thing from 2009 through the 2010s, buying higher and higher. And in this drop right here, they might have felt like they lost more than 35%. And why is that? Because they were buying probably more and more as their career was developing and investing more for retirement, and they were buying higher. So this once a decade sell signal, I think it's crucial. I think this decade business cycle is probably more important than super cycles, really, and is the most important, I think, in relative to your career, your business, your retirement, and your investments. So this chart is the S&P 500. Actually, it's the futures, but it doesn't matter for our perspective. What I want to show you is during the year, we come up with level 1 tops and bottoms, level one trends. This is a level one uptrend, level one downtrend. This is a new level one uptrend. So the point is, a long-term buyer could add additional funds there. But if they were automated investor, then they may not care. It's just something to watch, monitor how it's developing long term. But if they also wanted to take their portfolio and maybe take some profit, like at this level one, then they might be able to buy it cheaper. And if they reinvested their profits, then they could buy more shares. So they're gearing up so they can make even more on the next level one, but more during the long-term bull market. Now, for those who are interested in just trading during the year, then we have about 2 to 3 opportunities per year for these level one trends. Okay, when the market might drop -7, -11%, if it's in a long-term bull market, it could even drop as much as 36%. In a bear market, it's more likely to drop 20%, okay? Now, inside of that is a level two, and normally it's just some kind of halfway point, but occasionally we get thrown a curveball where there's an additional level two. Level two normally would make and lose just a little less, and it also takes less time, but sometimes it crosses over into the performance of level one, okay? And all of these have a wide variable performance. And why is that? Because standard fundamentals explains about 20 to 80% of price fluctuation, and that's not just my opinion. It's the opinion of professionals that have been around for many decades and become billionaires dealing in all kinds of markets, okay? On the other half of the story is 80 or 20% explanation, and it's more the technical, quantitative, the machine, the marketplace, the money. And I like combining both for a more complete story, and these business cycles help me with this. And even if you're a stock picker, you might say you're not that interested in what's going on with the overall market and stock indexes. But these days, a majority of stocks seem to have a fairly good correlation with the stock market. So this at least would be background information on when you might expect your portfolio to take a hit because the stock market is coming down quite a bit, or that if your portfolio is engineered towards the index and the index is due to make a large run-up, why you're going to make a nice return in your stock. So it can help out with the stock pickers. And then I think stock pickers ought to diversify a little bit and have some just stock index investments, whether it's futures on the indexes or they buy an ETF fund like the SPY. You can also double up and get more leverage using something like an SSO fund and DDM fund. And there's the QQD, I think it is, for NASDAQ. You can get a 2-to-1 return, okay? And ramp up your, and I do that quite often in my own investments here. All right, at any rate, that's, now we also break this down into where you can see these little pops and drops on a weekly. Well, that can actually be a daily chart. So this is a model chart I actually show my subscribers of when we're picking these tops and bottoms. And this is not just chart reading, it's not just technical. I'm finding some level one, level two patterns in fundamental and news and data. And then I'm finding those long-term patterns for the economy and also various business statistics and news and data, okay? And we want to relate that. But we can also do something on a more short-term basis. And as I'm flipping over to this short-term basis, I want to tell you that I apply this again to Bitcoin, dollar, interest rates, bond market, the oil market, and gold, and all of that's included in the stock market update, okay? Whereas I have a separate service for just grains, a narrow base of commodities, some New York softs. All right, let me give you an example of what goes on for a short-term to very short-term basis. This is a daily chart of the S&P 500. And yes, we have the more important signals that we get during a year, but we then have a signal per month. And that may help you if you're interested in more short-term. I don't try to put alerts out on those. It's more analytical, but I do put out alerts on level 2, level 1, and all of the long-term and super cycles when I try to pick the top and bottom. And yet it's really the model trying to pick it. But I do also add my own opinion of, is the model going to do that well this time or not, whatever else I can add. For these level 3s, it's basically like a monthly buy sell signal, if you will. It's the largest up and lengthiest up and down move during a month. Inside of that are level 4s, and sometimes I show intraday charts for people even in our weekly updates. And so basically these are like level 3 bottoms here. We're looking for a level 3 now. We've seen a level 3 top. It's inside of an uptrend channel. We think it's going to move higher eventually, but we got to deal with an inflation report tomorrow. We got to deal with the Federal Reserve next week. So we look at those things as well. But yes, I have intraday charts, but really for this service, it's not a day trading service. It's not really an intra-week type buy-sell service, but I do try to give clues. Is it going to be an up day today and maybe down tomorrow? How does that fit in that level 3 trend? So the bottom line is I have something to offer the very short-term trader all the way to the very long-term trader, the buy and hold type investor. And then provide some interesting insight of where's the economy going, so it can actually help you in business thinking and modeling and business planning even. I view the market as a fuzzy logic system, and a lot of computer programmers, trading, investing, view it the same. But this business cycle makes some sense out of it so that we have more order than chaos, and allows us to get an edge on keeping up with the market, but also even forecasting. Yes, I'm trend following as a backup, but I also like trend timing, and I believe everyone times whether they believe in it or not, or whether they like it or not. So in my opinion, I might as well try using it. And the trend timing has helped me personally over for 30 years now in stocks and commodities. All right, that's the monthly update. Get on board here. We've got a fantastic journey coming in this stock market and economy the rest of this decade, and some fascinating things to go on with the monthly or the decade pattern, but also during the month and the year. And I'll close out here with this monthly chart. And that's where we're at today as of February, up 132% for the minor long-term trend from 2022, and up more than that. 132% up from 2020, and then we're up about 46% since 22 bottoms, and the model did very good of assisting us finding those bottoms. Past results not necessarily indicative of future results. Have a good day. I'm Rich Poston for Critical Point. Thank you. And there's our 2 websites to look at. Plus, we hope to look at using other hosting sites in the future here to help present our product. Thank you.